it, move it. I like to move it, move it. I like to move it, move it. You like to move it.
Welcome to another episode of I Like to Move It, the Romeka podcast, where we discuss the most relevant and interesting topics related to material handling world. Today we have a fascinating topic to explore. China's ascension from a negligible share of world commodity demand to global leader seems to be peaking, and India is starting to emerge. Join us as we delve into this topic and discuss its implications for the global economy. I'm your host, Mr. R, and today, with me in this episode, there is a pleasant return. Tim Clark, the head of mining research for SBG Securities, a division of Standard Bank. Standard Bank is the largest bank on the African continent and is deeply involved in supporting customers in the mining, manufacturing, and commodity sectors. Tim is a mining, paper, and commodity analyst for almost 20 years and deals with bulk materials, base metals, energy, and paper markets. Tim follows the large global and South African diversified mining companies, as well as the paper companies listed in South Africa. Welcome, Tim, and thank you for being with us.
Thanks, Mr. R.
In our last meeting, we discussed your views of commodity cycles being divided into economic, developmental, and technological. We discussed the current economic cycle in detail, and you introduced us to China as a developmental supercycle. Please remind of your thoughts on commodity cycles and developmental cycles.
Just as a quick reminder, we think of commodity cycles in different categories. We don't think of it as one homogeneous thing. The first category is really the economic cycle, which is the most familiar to all of us. It's interest rate environments, inflation, and demand, following normal economic cycles from growth to recession, and it's dominated by OECD economies around the world. The second one is really a developmental cycle, and that's going to be the focus of our episode today. But just to sort of contextualize, that really involves the urbanization and industrialization of an economy, the move of people from rural environments to more urban environments, from low value add to higher value add jobs, and the build of inventory all the way from roads and railways, buildings and bridges as people urbanize. And then the third cycle that we often talk about is a technological or technical cycle, which we'll discuss in a later episode, where some change to regulation or to technology results in a significant growth in demand for certain commodities. Think of the emergence of the microcomputer leading to the laptop and the cell phone, the transistor chip effectively over time. So let's just go in a little bit more depth into today's topic, which is developmental cycles. There have really been several significant development cycles over time, but let's just focus on a couple of them. The Industrial Revolution in Britain with the emergence of the steam engine, the emigration and industrialization with the move west of the United States, Japan, the emergence of Japan as a manufacturing superpower in the 1970s, the Asian tiger emergence in the 1980s and 1990s. But more recently, nothing compares to what we've seen from China. After Deng Xiaoping opened Chinese markets and trade, urbanization and industrialization exploded. This resulted in an unprecedented build of inventories of commodities from buildings, factories, roads, all the way from the late 1990s, but really the strong demand growth came through in the sort of early to mid 2004 type of timing, where we saw very strong commodity demand growth. And we've seen that growth remain in place all the way until recent reports. We think we're right at the point where the end of this China developmental cycle is emerging. Urbanization and industrialization rates are peaking, but we do think that it's a more of a move from here into services and a consumer economy, but it's not an easy transition to make, and it will take a significant amount of time and effort.
There is clear evidence of imbalances emerging in the Chinese economy. What is the outlook?
Frankly, right now, this is the million-dollar question. Many commentators, myself included, over time, have felt that Chinese debt levels are somewhat high, that real estate and infrastructure spend is maturing off a high base, and that demand growth is slowing. And also that the population seems to has peaked and is starting to decline. In truth, China retains considerable flexibility, as there's very limited external debt. The economy is broadly closed to locals, and hence high savings rates going into banks and other wealth products are recycled into investment. China's also had a centralization policy which is pragmatic. And as events change, China tends to change with those events. As evidenced at the end of 2022, when China went from hard lockdown on COVID, with a completely closed economy over quite an extended period of time, to complete openness, almost overnight. Another change that's come through recently is, the renewables change, the energy transition change. China leads the world on battery electric vehicles production, on battery production, but also on producing its own renewable energy. I think China worked towards adding 80 gigawatts of power last year of renewable energy, more than the rest of the world combined in some categories. The government also owns and retains ownership of significant amounts of state-owned enterprises, land, and other assets. And that will allow a slow and steady process of wealth creation through some form potentially of privatization or sharing that could drive another step in China towards its goal of being a more balanced, services-led, consumer investment economy. So in summary, we think that China's emergence as a demand driver of industrialization and urbanization is probably slowing, but that significant amounts of tools remain, and that the relatively low income economy, relative to some of its global peers, does leave the potential for wealth creation and, as a result, for continued support from the Chinese economy.
Which commodities are best exposed at present?
China has the largest and strongest steel market in the world. It produces around about 1 billion or a little bit over 1 billion tons of steel a year. That's 60% of the world's steel. Steel is broadly used, but it's very much an infrastructure and real estate dominant commodity. We think that these areas of demand may have peaked and are likely to plateau and potentially come down over time. We also think that as scrap comes through, as rebuilds start coming into the economy, other than sort of new inventory build, that steel is likely to face a little bit of pressure over time, but is well supported at the present. We also think that the investment into renewables, grid developments, battery electric vehicles, the new battery economies is very supportive of base metals, a lot of battery metals, and copper in particular over the next few years. Just remember that your coal mines, which have driven your grid for now, are not where the sun shines and the wind blows, and hence you need to do very significant grid expansion alongside renewables and rebuild and rejigging of grids all around the world in order to supply renewable power into your grids. There also is the need for battery backups, because renewables is not a consistent baseload supply. In addition to that, there's also a trend of income growth in China and a rise in middle income, and this supports consumer durables demand and food demand. Really, that is overall supportive for base metals and for fertilizers. So we remain pretty bullish over the longer term on base metals, precious metals, PGMs and fertilizers, perhaps less so for the bulks, thermal coal particularly, but then also to some extent steel-making raw materials.
Is there a new China on the horizon? Do you see urbanization and industrialization of other economies driving demand growth?
In the near term, India has been very strong. Last year, we saw very significant steel growth and demand growth coming out for commodities coming out of India, and we think that this is likely to continue for some time. The base is quite low relative to China, but we do think that this is going to be a source of incremental growth for some time to come. We also think that Southeast Asia is likely to be supportive of growth as the same urbanization developmental trends play out. Cambodia, Vietnam, countries along these lines are likely to continue developmentally pushing their economies forward. We think, though, that China's Communist Party and central planning has allowed it to compress its demand growth into a very short period of time, and it's more likely, given healthy democracies and time frames for making changes and planning and in talking to communities, that it's likely that those other economies, India, Southeast Asia, will advance over time, but perhaps at a slightly lower pace than we've seen out of China more recently. And then at Standard Bank, we have a strong belief that Africa is going to be a very big source of growth. It's a huge portion of the world's young population, and we think that Africa is going to have a a century of growth and become a very significant demand growth driver over the next few decades. And certainly we're big investors and believers in that trend.
Thanks, Tim. What an interesting perspective on China as it enters the year of the dragon. It is incredible how the economic emergence has driven a real boom of commodity demand. Next time, we will discuss the energy transition technological cycle. Thanks again for listening. We'll see you next time on I Like to Move It, the Rolmeca podcast. Thank you for your attention, and I look forward to seeing you next time to explore together again the most interesting new trends and developments in the world of materials handling. Take care and keep being awesome.
I like to move it, move it. I like to move it, move it. I like to move it, move it. You like to